right? So for a typical model structure, you have three main buckets, right? You have the inputs, you have the computation, and you have the outputs. So the inputs is where you put in the assumptions of how you expect your business to perform in the next few years, right? So for example, you expect that maybe currently you're selling 500, let's say you're selling 500 amount of, what can I use? Let's say you're selling bags, for example. So you sold in 2021, you sold 500 bags, right? You sold 500 bags in 2021. And for each bag, you sold 500 bags and you sold them at, let's say, 10,000 naira, right? You sold them at 500 at 10,000 naira, right? So that's about 5 million naira. That's 50. Let me say that again. So you sold 10,000, you sold a bag at 10,000 naira and you sold 500 of that. So that's 500. That's 5 million actually, right? So you made 5 million in revenue. And then for those 500 bags you sold, the cost of paying the person, the cost of the material and paying the person that made the bag and all that was, let's say 7,000 naira, right? So that means your direct cost is 3.5 million naira, right? And then let's say your business is not, let's say you're just starting your business and you're not paying tax yet, right? So that means your operating profit is 1.5 million naira, right? And then once you now start removing up money for administrative expenses and rent and all the transportation and all those kind of things, let's say I left you 1 million naira, right? And then in 2022, you've seen that, oh, this business is doing well. Okay, so let me increase the number of bags I'm making by 3. So multiplying that by 3. So that's, you want to make 1,500 bags, right? So, but for making 1,500 bags, you now need maybe a bigger car or a bigger truck to transport the goods, and then you need to now pay the bike man delivering the goods more money. You might need to rent a bigger warehouse and all those kind of costs and assumptions that you expect to happen within the next 5 years in your business. And so all these assumptions will be on your inputs, and then that's your revenue assumption and OPEX assumptions. Then for your financial assumptions, so let's say you made 1 million naira in profit last year, and then you don't want to withdraw the 1 million naira, you want to reinvest it back as share capital or as retained earnings in your business. So that's an example of a financing assumption, but you're increasing your production by ×3, right? So you might need more money in your business. So let's say you now see that, okay, you have a 10 million deficit that you need to bridge for you to be able to run up efficiently. Then your financing assumption now makes the assumption that, okay, do I want to raise equity for my friends? Do I want to give my friends equity and tell them that, okay, if you make 10 million naira, get 5% equity in my business, or you get 10% equity? And do I want to do 30% of the money, or do I just want everything that I need to be equity? So those assumptions also matter because it helps to now drive and know if you're paying any interest on your debts. And if you decide to pay dividends, for example, that assumption also helps you to now see how your business is performing in the future. And for example, let's say you need to buy a bigger car to transport your goods, or you need to buy more bikes for your delivery guys, right? So that's a capex because you're going to use that bike for, let's say, 3 years or 5 years, or you're going to use that car for 5 years, right? So that's a capex assumption. So as the assumption on, okay, in 2022, I want to buy 3 more bikes. In 2023, I want to buy 5 more bikes. And in 2022, the price of the bike will be this amount, and so on and so forth, are the inputs you need. And then the competition is just pretty much calculating these assumptions, right? So you know that you're selling one bag for 10,000 naira. So if you sell 500 bags, that's 500 times 10,000 naira. That's 5 million. So those calculations that you do is what you do on your computations, and then now linking and combining the computations together to get an output, which, for example, you multiply the amount of bags you're selling times the price gives you the revenue, And then all the direct costs you're going to spend on that business gives you the expenses. If you're paying, if you borrow the money, if you borrow money from if you borrow money from a bank or from a friend or whatever, you might need to pay interest depending on the kind of debt. If you're paying interest, that needs to go to your income statement, right? And then that also needs to go to your cash because you're paying out from your cash, right? And all this, look at this is just a very basic line diagram on how a typical model structure would look like, right? And then moving on to explaining the process of building models in more detail, right, in another dimension, right? So the first step you need to do is so you understand the scenario that you're trying to model for, right? So you need to now carry out extensive research to further understand the key things, the key assumptions that need to go into your model. For example, if the company you're trying to model for will be buying some goods from the US, right? So that means you need assumptions on what will be the exchange rates in 2023, what will be the exchange rate in 2024. So you need to carry out some research to know what the likely exchange rate is going to be at that time, right? And then if you also need to carry out research, so let's say your competitors are selling their own bags for 8,000 naira, right? And they are selling yours for 10,000 naira. So you need to consider that and know that, okay, should you actually sell yours at 10,000 naira or should you reduce the price? If you're selling yours at 10,000 naira, then you might need that, okay, for you to sell at 10,000 naira, the quality has to increase. And for the quality to increase, you need to use better materials. And that means more cost of materials for your business. And that might also mean more marketing you need to do more marketing, maybe social media, whatever you need to do. So that understanding and carrying out this research and analysis is very important for you building the assumptions or building the input and assumptions that your business should use to perform in the next couple of years. Right. And then after carrying out the research and fully understanding what you need to do, you then need to design a model layout, right? So you need to understand that, okay, you need to probably have a sheet where you need to have a sheet where you have the assumptions, right? You may also need to have a sheet where you carry out the calculations, right? And then you may also want to have you may also have you also have to have sheets where you show the income statement, the balance sheet, the cash flow statement, and then maybe sheets where you carry out analysis. So the let's say you want to see the liquidity ratio, you want to see the asset turnover ratio, and all those kind of ratios that you want to see to further help you see how your business is performing. You may also want a sheet where you can see that. And then if you want to build some charts where you can see some interesting things on a trend basis, you can create a chart for that too, right? And after doing that, then you need to put in if you have historical financial information, you need to create an historical financial analysis where you compute the historical information you have, such as let's say, for example, you have 2021 financial statement, 2020 financial statement, 2019 financial statement. You can analyze those numbers and then try to figure out a trend in their performance. So let's say, for example, in 2019, revenue grew by 5%. In 2020, revenue actually dropped by 10%. And then in 2021, revenue grew by 5%. And revenue dropped maybe because of COVID, right? So now understanding those trends, right, can help you can help you gain some insights and then know the key things you need to build for your forecast model. And then the forecast build is the stage where you build the forecast, the future performance of your business based on the analysis of your historical financial performance, and then based on the assumptions of how your business wants to perform, which can be gotten from research and analysis or by speaking to management and top people in the organization that are driving the strategic direction of the business, right? So after building the forecast build, then you need to you need to build in your ratio analysis, you need to build in your financial statements where you link those things together. And then you also need to build your dashboard that shows a trend of the key informations at a one-eye view.